Let's look at the other side of the picture. Why would you, first of all, why would you want to give away something that had declined in value? You spent $1,000,000 for it and it's only worth $350,000 now. Why would you want to stick your kid with that? Why wouldn't you want to just sell it? Well, first of all, as we'll see in the next set of slides, it can be very difficult to deduct your capital losses. And most of the things you give will be capital assets. And we'll define all those terms in the next set of slides. And so selling it might not do you any good at all. And so we might be in the original situation that the government is afeared of, that you have a relative who has a lot of capital gains. And if you pass this capital loss to a relative with a lot of capital gains, they can save some taxes. All right, so that would be one scenario. A second scenario would be, this could be the family vacation home or that really hideous tea service that great Aunt Betsy gave you that's been in the family forever, that you want to pass on to Junior to get it out of your house, or just because you really think Junior should appreciate it. All right, so that would be a situation where it's worth a whole lot less today than it originally was, but you want to keep it in the family. And then the third reason is one that happens a lot, right? If you are rich, you see declines in the stock market as an opportunity to make distributions to your relatives at a very low transfer cost. So if you're sitting on millions and millions of dollars and you want to give some of it to your son while you're still alive, remember we have the transfer tax that kicks in once you exceed the exclusion. So if you have a choice between, it's 2008 and you can give away some stock that's worth 30% of what it was worth in 2005, you're going to be thrilled at the opportunity. All right. So a lot of really rich people, when the market tanked, they went through their portfolio, and if they thought it was hopeless, something wasn't going to come back, they probably bit the bullet and sold it. If they thought this is something that will definitely come back, this is a really good time to transfer it to my kid or my grandkid, so that when it does come back, my kid will get all the upside, but my transfer tax will be as low as I can possibly get it. So 3 different reasons why you might want to make a transfer when the fair market value is less than basis at the date of gift. So let's talk about the math involved. All right, first of all, there is no adjustment for gift taxes, and that shouldn't surprise you, because remember, the formula was appreciation, which was fair market value minus basis being greater than 0 over the fair market value. Well, if you're going to get a negative number on the top, that formula is not going to get you anywhere. All right, so if you are giving away something that you spent $1 million for, that's worth $750 now, there will be no adjustment for gift taxes. Now, to be consistent, I'll always give you the gift taxes in the problem, because remember, gift taxes are based on fair market value. The government doesn't care whether you have made money or lost money on this ownership. They only want to know, what is the fair market value right now? Have you exceeded your exclusion? If so, pay us taxes. Adjusted basis is now determined when the donee sells. And the reason for this is, remember I alluded earlier, the government is very paranoid about these transfers being designed to pass losses on to the hands of a relative who's got a lot of capital gains. Losses that might never otherwise be used are going to someone who's got lots of capital gains, and so they do not want that to happen. So we're going to determine the basis when the donee sells the property, and we got a slide coming up for that. If you're going to depreciate it, use the smaller of the 2 numbers. Use fair market value at date of gift, which shouldn't surprise you, right? To use the smaller number saves the government money. So if it was a car that you are going to use in your business that grandma gave to you, you would use the fair market value at the date of gift. So first of all, we're going to talk more theoretically about how the numbers work. And then in the next slides, we've got an example, and we'll run through all the numbers a little more in detail. So remember that Grandma has made the gift. She has paid gift taxes or not, depending upon her history of giving. The fair market value was less than basis at the date of gift. So Junior is not going to actually know his basis until he actually sells the property at a later point in time. So in our first example, Grandma's right, and it is going to get more valuable. So the basis of the fair market value has become larger than the original basis. And in that case, Junior gets to use all of Grandma's basis. So to put it in more concrete terms, Grandma paid 12. The fair market value was 10 at the date of gift, and Junior subsequently sold it for something greater than 12, so let's say 20. So if he sold it for 20, the property fully recovered in value, and he can use all of Grandma's basis. So he can't use Grandma's basis to create a loss, but he can use Grandma's basis to offset gain if there is full recovery of the property. So the second example is the less cheerful one. The property continues to decline in value. And so when he turns around and sells it, it's worth even less than the fair market value at the date of gift. So when that transfer happens at the date of gift, the fair market value has been locked in as the smallest number that Junior's basis can be. So any further declines in value are on his nickel. So he gets to recognize those losses because that decline from $10 to $8 incurred while Junior was the owner. So by using his basis at 10, he'll be able to recognize that loss. And then if he sells it anywhere in between Grandma's original basis of 12 and the fair market value at the date of gift, we're simply going to plug the basis. All right. So for instance, Grandma paid 12. It was worth 10 at the transfer, but Junior could sold it at 11. So 11 is between the 12 and the 10. So his basis will become the same number as his amount realized. And subsequently, he'll have no gains or losses recorded on this transaction. So any recoveries that happen between the 10 and the 12 are absorbed by using part of Grandma's basis. So here's a more concrete example. I like to call this my Price is Right game. All right, remember those where if you've ever watched a show, you have to pick a price, and they give you a floor and a ceiling for the price, and you simply have to stop the arrow at the right number in between. So that's essentially what we're doing here. Right? Our basis will never be lower than the fair market value at the date of gift. It'll never be higher than the donee's basis at the date of gift. So here's our original facts. When it was worth 10, Grandma had paid 12 for it originally, and she makes the transfer. So our Price is Right game, our basis when Junior sells it, will be somewhere between the 10 and the 12. So you can see we have three separate cases. He sells it for more than the original adjusted basis. In C, he's selling it for less than the original fair market value. And in B, he's selling it somewhere in between. All right, so this is essentially the same information as we had on the prior slide. But here, hopefully, we're going to get concrete enough that you can figure out what's going on. So what is adjusted basis? That's the amount you subtract from the amount realized to calculate your gain or loss. And that will determine your total gain realized, right? Amount realized minus adjusted basis gets you your gain or loss realized. And remember, realized is just the math. It's not necessarily what shows up on the tax return. So here's our numbers. So when we sell for 13, that's above the original basis, so we'll get 12. When we sell for 9, it's below the original fair market value, so we'll get 10. If we sell for anywhere in between, we just plug the basis. And so you can see our gains and our loss. So had he sold it for $11,250 or $10,502, you would do the same thing we did in number B, which was the amount realized in the adjusted basis will be the same number, because for every dollar it recovers in value, Junior gets to bring $1 of Grandma's original basis over to use. So there'll be no gain or loss recognition. And what happens when we convert from personal use? We got a car, a computer, a building that we're going to transfer from being our personal stuff to being business property. All right, so it's going to be similar to the gift rules. So remember that at the date of conversion or at the date of gift, if fair market value was less, we used fair market value. If fair market value was higher, we used adjusted basis. We're going to use exactly the same rule here. If fair market value is greater than basis, use basis. If fair market value is less than basis, use fair market value. Right, so exactly the same rule. So here's a couple numbers. The adjusted basis is 16 and fair market value is 8,005. Fair market value is less than adjusted basis. So if you're not sure which one to use, go back to the prior slide, make sure you know. All right, if this shows up as a question, you want to make sure you get all the points, right? Because this is a very simple question. And the answer is 8,500, since fair market value is lower than adjusted basis when property is converted. And with the exception of buildings, this is probably normal situation, right? If you use a car or a computer or a lawnmower personally and then convert it to business, it is likely that it will have declined in fair market value because you've used it, right? It's no longer that brand new thing that you bought. It's now secondhand. So most transfers or conversions will look like this. And the government's position is that decline in value is a non-deductible personal expenditure. So last but not least, what happens if Grandma holds on to it until she dies? She will not let you have it until you grasp it from her cold, dead fingers, right? That's what we call inheritance. We're not going to cover it here, but there are some very complicated rules for gifts made within the last 3 years of death to determine whether they were really made in anticipation of being pre-inheritances and should be treated as inheritances, or were they true gifts that should be treated by the rules we had before. We're not going to cover those rules at all. Just know that if you want to be clever and schemy, when you get the diagnosis that there's only 8 months left to live, the tax code has probably got you covered for that. And if you get too aggressive, you're not going to get the results that you wanted. So this is a pretty simple rule. First of all, understand that you, the inheritor, have absolutely no role to play here other than to receive the item and be told what the dollar amount is. Whoever the executor of the will is will make all determinations. Now, most of us will never pay an inheritance tax any more than we will pay a gift tax, right? Most of us will not die with millions of dollars of property. And so normally, what are we distributing out? Mom's house and maybe a little bit of bank account, some stock. And so most of us will never pay an inheritance tax. But for those really rich people, what they will do is they will determine the fair market value of everything that was owned at the date of death. They will look at how many gifts were made during the decedent's lifetime, and they will determine from that information how much of the lifetime exclusion for gifts and inheritances is left, and then they'll do the math, right? And so the executor has a choice to make here. The executor will make that choice, and all of the recipients simply have to live by that choice. So the general rule is the executor is going to choose fair market value at the date of death. That will be the amount reported on the estate tax return, and so that will be your basis. So note here that many times what people get is a step up in basis, right? Grandma bought the jewelry Back in 1912, she paid $1,000 for a ring that's currently worth $50,000. So if she had sold it, that'd been $49,000 worth of gain. If she would have given it to you and you sold it, you'd have the same amount of gain. But if she holds on it until she dies, it gets reported in her estate tax return at $50,000. She'll pay a transfer tax potentially based on the $50,000. You will get the ring. That will not be a taxable event to you. Your basis in the ring will be the full $50,000. So if you immediately sell it, you will not have any gain recognition. Okay, and the alternative valuation date is 6 months after the date of death, and this is a one-size-fits-all rule. The estate can determine to value everything in the estate at the date of death, or they can use a date, which is 6 months later. Right? So they can use fair market value in either case, either the fair market value at the date of death or the fair market value 6 months later if it's owed, lower. Remember, the gift taxes are gift and estate taxes are really expensive. So the executor is not going to make a decision to pay higher death taxes, which can be as high as 50%, in order to save you capital gains taxes, which could be at 0, 15, or 20%. That just wouldn't make any sense at all. So the executor will tell you you got this, and its basis to you is Y, and you simply use Y. You don't have any right to argue that number. And if for some reason it was something that they gave you in month 2 and you immediately sold it, which happens in some cases, right? I need the cash. Then you would use the amount of that fair market value at the date you received it and sold it. And then this last bullet, the holding period, which will mean something much more when we move to the next set of slides, is always long term. So grandma bought it on Tuesday, got hit by a bus on Thursday. It got distributed out to you 2 weeks later. You immediately sold it. Whether you have a gain or a loss, it will be a long-term capital gain. And like I said, that'll mean something when we move to the next set of slides. All right, so then a few slides on selling stock. And actually, it could be preferred stock too. It's not just common stock. So selling stock, you have some choices in picking your basis. All right, so this is similar to GAAP in the sense that there's generally choices within the menu of what's acceptable. So specific identification, if you actually know the price for each of your stock, you have 5 shares of stock for IBM, you know exactly when you bought them, you know what your basis in each one was, you can say, oh, I'm selling this the June 13th, 1912, or I'm selling the December 8th, 1942, or the May 5th, 2004. You simply say, right? But that's only if you have really good records and you know, right? So you can do it any way you want. Most people will simply do first in, first out on the assumption that that's a simple, easy system. All right, and first in, first out will work just like FIFO inventory. The first stock you bought is the ones you would sell. Or you could simply average the cost. And this is used by a lot of people because if you reinvest your dividends, you may have absolutely no idea what your actual basis is for any particular share of stock because you got 8,000 shares of stock. But you know what you have paid each time you bought a block of stock, and you know how much you have paid in dividends that have been reinvested. You can simply add all that up, divide by the number of shares of stock, and use that number for all sales of stock, that average number per share. Wash sales are our last real topic here. We'll spend just a couple of minutes on installment sales, but remember, we're not doing much with them. So what is a wash sale? Well, you are going to learn in the next set of slides that if your capital gains and losses net negative, you cannot use that loss. But you're also going to learn that if you have a gain on one stock, if you recognize a loss on a second stock, you can net those two together. So I can use a loss on stock C to offset a gain on stock A. So it is very common for people to go through their portfolio as they approach the end of the year. And they look for, first of all, they look for dogs, right? Things I really wish I never have bought. And I know it's a really hard thing to do, but the financial advisors say sometimes you need to give up, right? Sometimes you need to say, this stock was a huge mistake. I'm going to take my loss. I'm going to get out of it because it can't get any better. It's only going to get worse, right? A very difficult thing to do. A second thing that some people do is a stock is currently in decline, but you're pretty confident that it's coming back. So being a savvy person, you've just sold some stock for a big gain. You say, well, I currently could recognize a loss on this stock. Why don't I sell it? I'm going to realize the loss, reduce my taxes this year, but I'm going to buy it back, right? And nowadays, broker's fees are $6, $7. So there's not a lot of transaction cost involved here. If I can recognize a $10,000 loss, offset my $10,000 of capital gains, I've saved some real taxes here, right? But I believe in the stock. I know it's coming back, so I want to put it back in my portfolio. So a wash sale is I'm trying to wash the loss out by selling it, realizing and recognizing the loss, and then buying back the same stock. And the real is you can do that, but not if you do it too quickly, right? There's got to be a waiting game here. So I want to avoid buying back too fast, right? I sold and bought back the same day. So in substance, I never really changed my ownership, right? So I should not be able to recognize a loss. So it's a sale of shares that realize a loss and substantially identical shares are repurchased. So if you've got a really complicated structure and you bought non-voting C shares and that's what you sold, you might be able to buy back non-voting B shares if they're different enough, but not if they have exactly the same provisions. And the rule is 30 days, that 30 days plus or minus. So the stock market's pretty volatile. So the government decided that the market could change significantly within 30 days. So if you wait 31 days and buy it back, there's no problem. And because people are sneaky, they added the before or after, right? So I can't sell it on Tuesday. I can't buy new stock on Tuesday and then sell on Thursday saying, hey, I'm not repurchasing anything after my sell date, because from the date of sale, you have to look back 30 days and forward 30 days. Any purchases within that 60-day window will cause you to not be able to currently recognize your loss. So that loss is going to be deferred. Right? And deferred means it'll come back later under the right set of facts, but I cannot use it in my current tax return. All right, so 61-day period. The date of sale, 30 days back, 30 days forward. All right, so we don't want to beat this topic to death. It can be very complicated. This slide just says that sometimes a purchase divestiture does not trigger the wash sale rules. In any quiz/test question I give you, we will be talking about the generic I bought IBM stock, I sold IBM stock for a loss, and I repurchased IBM stock too quickly, and so I cannot use my loss. When we have a deferral of gain or losses, and this is the only one we're going to have till Chapter 11, and Chapter 11 will be in basically the very last set of materials that we cover. So we'll need this rule again because we will defer some losses there. When you defer losses, they haven't been disallowed, so you have to have a mechanism to allow you to include those losses in your bases for the new stuff. Right? So when we defer losses, when we can't use them, we want to make new bases higher, right? Because remember, it's amount realized minus adjusted bases. The larger your basis is, the more likely it is you'll generate a loss. So we conserve losses by adding to our bases for the new property. So we're going to basis of the new shares. So in a wash sale, I've sold 100, bought 100 back too fast. I'm not going to be able to recognize the loss on the original 100. So the basis on the new shares will include what I paid for them, plus, because we want to make basis larger to conserve the loss, any postponed deferred losses from the old sales. So we've got some slides coming up, but if I had a $10,000 loss on my shares, I bought them back too fast, that $10,000 loss would be deferred or disallowed. I would add that $10,000 to whatever I paid for the new shares. And then the holding period, what we call tax, right? So if I own the original stock for 3 years, I buy the new stock, it's a wash sale. I have to add my deferred loss to the new shares. That will automatically be a long-term gain or loss when I sell it, whether I sell it in the next 5 minutes or the next 5 years, because those original years of holding from the first set of stock tack or add to the holding period. And once again, holding period will make a lot more sense when we finish the next set of slides. So we've got a couple examples coming up for wash sales. In the first one, we're going to buy back everything we sold. So we'll have a complete disallowance or deferral of our loss recognition, and we'll add the whole loss to our basis. And in the second one, we'll only buy back a few shares. So we'll have a more complicated math to deal with. So way back in the day, we bought a bunch of shares, 50 for $200 per share. On December 10th, we sold them for $160 a share, which gives us a realized loss of $40. We would like to recognize that loss, but that depends on whether or not this is a wash sale. So I have to tell you whether there have been any purchases of substantially identical stock going back 30 days from December 10 and going forward 30 days from December 10. And it turns out that a few days earlier, we did repurchase 50 shares at a little bit lower price than we actually sold it. But the selling price does not matter. The fact remains that we purchased substantially identical stock in the plus or minus 30-day period, focusing on the date of sale. And so we are not going to be able to recognize that realized loss. And so let's go and answer all the appropriate questions on the next slide. All right, so is it a wash sale? And the answer is yes, because of the December 2nd repurchase. If it is a wash sale, how much loss is going to be postponed? And that will be a function of the number of shares that we repurchased during the plus or minus 30-day period. How much is recognized? Well, that would be only if we had repurchased less than we actually sold. So we'd recognize the loss relating to the shares we did not repurchase. And here the answer is 0, right? Because we sold 50, we repurchased 50. So we've tainted the loss recognition on the entire 50. And then we're going to determine our basis of the new shares. So what we have to do here is what we paid for them. Add to that any loss we're not going to recognize because we triggered the loss sale rules. And then the holding period, right? So if the new shares are subject to the wash sale rules, then the holding period will tack. If they aren't, then we'll have a brand new holding period. So let's say again everything we said on the last slide. It is a wash sale because two events occurred. We sold the stock, realizing the loss, and then within 30 days plus or minus of the sale, we repurchased the 50 shares. So that is our definition of a wash sale. We sell stock, we realize the loss, we repurchase substantially identical shares plus or minus 30 days of the sale date. So that means in this case, we bought back everything we sold, the same number of shares. So we defer all of the loss. Our basis in the new shares will be the purchase price plus the loss deferred on the 50 shares. So we paid $140 for the new shares. We have a deferred loss of $40. So our basis is $180. the holding period tax, so we're deemed to have purchased this stock in 1997. In this example, we're going to buy back fewer than the number of shares we sold, so only part of our transaction will be tainted. So way back in 1997, again, we purchased shares, $200 per share. We're going to sell 50 of those shares for $160. And on December 20th, which is after the original sale, but within the 30 days plus or minus, we're going to buy back just 10 shares at $140 per share. All right, so we're going to calculate our realized loss on 50. We're going to have 10 of them where we're not going to be able to recognize our loss. So we'll defer the loss on those 10. So we'll add the deferred loss to the basis of just those 10. The other 40 will be a perfectly valid transaction. We'll be able to both realize and recognize the loss on them because we did not taint them with a repurchase within the 30 days plus or minus. So once again, our questions. Is it a wash sale? And that answer will depend on the repurchasing information. So part of this was a wash sale. Part of it was a normal sale. How much loss is postponed? The loss relating to the tainted 10 shares. How much is recognized? In this case, the loss relating to the other 40 shares. And the basis then of the 10 shares we repurchased will be a function of what we paid for them and the loss we did not get to recognize. So then the holding period on December 20th shares will be bifurcated, right? We got 40 shares that are just a normal, I'm sorry, we don't own 40 shares, right? We only bought 10. So those 10 will have a holding period that goes back to the original date. And then the original 50 that we haven't sold yet will also be at that date. So let's look at our answers. It is a wash sale because we had a sale of stock that resulted in a loss of $40 per share. We repurchased, this time on the plus side. After the sale, we repurchased 10 shares. Those 10 shares are treated as a wash sale. We will not be able to recognize the loss related to those shares. So 20% of the total loss, 10 over 50, or you could just do it at 10 shares, right? We had a $40 loss per share times 10 shares. This is just math. You can do it any way that you need to. But the 10 shares we repurchased, we're going to have to defer that loss because we did not avoid the loss wash sale rules. And so we're going to recognize the loss on the 40 shares that we did not repurchase, but not the 10 that we did. So then let's go over the answers. We have 10 new shares that we repurchased. Those are the ones that we have to worry about the bases because those are the ones that caused 10 of the shares we sold to have a non-recognized loss or deferred loss. So the 10 shares, we're going to take the purchase price plus the loss deferred on just the 10 shares. You can do it at $40 per share for the deferred loss, or you can do it as 10 shares in total. You're going to get to the same information, right? So the 10 shares, we bought them at $140 a piece. So the way I've done the solution is $1,400. The loss was $40 a share. So we get to $400 for that. So that gives us $1,800 for 10 shares or $180 per share. And in the parentheses, I've just done it on a per share basis. Note we get to exactly the same answer. The holding period, the 50 shares originally not sold, because remember back in 1997, in this example, we bought 100 shares. We only sold 50. So we're sitting with 50 shares with their original holding period of 1997 and 10 new shares for which the original holding period tax. So they're also deemed to be purchased in 1997. So we own 60 shares, 50 with a basis of the original 200 and 10 with a basis of the 1,800 or 180 per share. But they're all deemed to have the same holding period, they're all deemed to be purchased in 1997. So when we have a subsequent disposition, that's the information we would use to choose how we're going to recognize our basis for the stock that we sell. All right, so not much on installment sales. Remember, we're not formally testing them. I would like to note that when you have taken depreciation on a property you're selling on the installment basis, you must currently or immediately pay taxes on the depreciation recapture. You cannot use the installment rules for that gain. We'll talk about that in part 2 of chapter 12. But just remember that an installment sale of equipment is not going to give you a pure recognize the income as I collect the cash treatment because of the role that depreciation and depreciation recapture will play. And then there are a lot of complications when a related party sells to a related party. We're going to ignore those completely. On, I believe it's the last tax return, you're going to sell some land on an installment sale basis. I will be giving you the form and part of the instructions. If you have a deep curiosity here, you can read the instructions. They are very illuminating. They will tell you a lot of information in this area. But as far as finishing this course and being done, all you need to be able to do is complete the tax form on a very simple scenario. So the short story is, when I have an installment sale, I get to recognize the gain as I collect the cash, unless I have depreciation recapture to consider. I'll see you in class. Bye.